Hello everyone, this is Professor Kent and today's recording is chapter 4 and we're going to be doing part B of chapter 4. In this part, what we are trying to do is we are trying to learn about different tax credits. So the next tax credit is charitable donations. We make donations. When you make a donation to a charitable organization, what we do is we get uh, a donation tax credit. Again, this donation tax credit is 15%. Now there is a A, there is a B, and there's a C. So first of all, 15% is if your donation is more than $200. So the on the first $200 we get a 15%. But if you made more than the $200, and then we have to calculate B and we have to calculate C. B is the lesser of total eligible gift less 200s and if now whatever your gift was, and what we have to do is we minus the 200. The reason we minus the 200 because we already took a benefit of 15%, and then what we need to do is every year our donations changes. So whatever your taxable income is minus your 246752. So this is the number that is given to us. So what we do is we take the lesser of those two. Once you take a lesser of those two, that will be the number for your B. So if you still donated more than when we got the calculation, so then what we do is the excess, if any, by which individual's total gift exceed the sum of 2000 plus the amount we calculated in B. So in B we are going to calculate amount. Here we had a 200. So once you have these two, and what we do is we add both numbers and then we minus it from our total donations, and that will be the number for your C. So now this will be a good question to work on an example to calculate the charitable donation tax credit. So if we look at an individual with a net income and taxable income equal to 300,000. So this individual's net income and taxable income is 300,000. What they did is they did an eligible gift for 210,000. Seems like the person spent out of the 300,000 spent 210,000 on donation, charitable donation. You see some people that are there. So when we are doing it, if you were to look at it, the maximum base for us will be 300,000 is their taxable income. 75% will be 225. That's the maximum we could donate, but this individual donated 210,000. So let's work it out. On the first 200 they're going to get a credit of $30. And now my next one is you're going to calculate your B. First you're going to look at the lesser amount and then you multiply by 33% to get your tax credit. So first one is, since we are donation, the total donation this individual made was 210,000. We already took advantage of 200 at 15% the tax credit for it. Difference between the both, we are left with 209,800, and your maximum base is 300,000 and minus your 24752 that is given to us by Revenue Canada. So then we take a lesser of those two. The lesser of those two is 53,248. Again, my donations are limited to 75% of your taxable income. So that's what you are limited to, 75%. So then when you did that, I multiply by the 33%. Sorry. To multiply by 33%, I will get 17,572. And my next tax credit is 29%. This is what is this? This is the total donation. So this is the total donation. We already got benefit. We already got credit of the 200 at 15%. We already got a credit 33% on the 53,248. Whatever the leftover is, I multiply by 29%, and what we're going to get, we are going to get a credit of 45,400. So if you donate 210,000, your credit that will be available to you will be $63,000. So now the general rule is the maximum limit is um, you are allowed 75% your net income. That's the maximum amount. But the year somebody dies, an individual that passes away, the limit becomes 100% of their income. 100% of their income. Now, this is the medical expense. So, sometimes some of the medical expense is not paid by your insurance company. If the medical expense are not paid by your insurance company, and what we do is we needed to calculate the medical tax credit for an individual. So what this is the formula: A, B, C, and D. So first you this is your bracket, and your A is 15%. Your B, what is your B? Total of eligible medical expense for individuals, spouse, children, and under the 18 years old. So you're gonna add your medical expenses, your spouse, any of your children that live under your roof and they're under the age of 18. You're gonna add them together. So you're gonna do total, and that is your B. And your C is lesser of these two numbers. So 3%, if I'm filing my return, it will be 3% of my net income. And this number is given to you by Revenue Canada every year. So this is the number for 2024, lesser of those two. If my net income, let's say $30,000, if I 30,000 multiply by the 3, it will be my 9,000. My index says is 2759, and I take the lesser, that will be your 279. So the total benefit is your B. C is the lesser of these two numbers. And then what we're going to do is then you're going to calculate your D. Your D is E minus the F. The total of amount for dependent 18 or older. So this is where you look at your dependent that are 18 years or older. So now we have to look at some kids are going to you're going to have some children that are at the under of 18, and some of the dependent, they live under your roof but they're over the age of 18. So you're going to take the total amount of for dependents 18 years of old. So you're going to do the dependents medical expenses. So whatever you paid for your children that are 18 years or older than that, then my F is lesser of 3% dependents net income and 2759. So the lesser of what? 3%. You take 3% of the net income, and what then we're going to go here similar to that, earned and 2759. So whatever their dependent income was and 275, what we do is we're going to take the lesser of those two, and then what we're going to do is we're going to minus it from each other. So that's how you're going to calculate your E and F. Let's see if we can do this example, and I hope this example will kind of help us calculate my medical expense. So this is a good example when we're calculating our medical expense. So when you think of it, an individual with a net income of 100,000, so this person's net income is 100,000 and the medical expense is 5,000. So he has 20-year-old, means he has a dependent that is older than 18 years. And has a medical expense of 10,000, and this dependent's net income is 9,000. First, I'm going to look at it. How much is my total expense? So this is my total expense, which is your 5,000. When then I look at it, 3% of my income. In this case, my income is 100,000, and that's 3%, that's your 3,000. And I take a lesser of these two. My lesser of these two is 2,759. My total medical expense that we paid was $5,000. So this is the total medical expense that the individual paid. So this minus that, that's the subtotal I get. Now I'm going to look at my amount D. In order to calculate my D, I needed to look my dependents medical expenses. They told us the dependents medical expenses are 10,000. Then what we have to do is we have to take a lesser of the income the dependent made, multiply by 3%, and then the threshold. The threshold is lesser of these two is 270. So your medical expense minus your 270 will be the medical expense that you're allowed to claim. But we cannot claim everything. We are going to claim 50, we're going to get a credit of 15% of that income. So this is the medical expense credit that the individual is going to get. Now disability, next one is my disability tax credit is if disability, if for any reason impairment must be severe and prolonged, so who qualify for disability credit? So it has to be that it's you cannot walk, you cannot feed yourself. That means you are disabled, you're dependent on somebody else to do things. And it has to be a continuous period of at least 12 months. So if that's the case, the individual is allowed to have a disability tax credit. The base of this tax credit in 2024 was 9,872, and we're allowed to do a 15% of that will be the maximum tax credit I'm allowed. Now I'm also allowed a supplement if your child is under the age of 18 and is a disabled. So when this is the base amount. So if this is the base amount, if I were to look at it, I have a disability credit of 9872, and then top of that we are getting a supplement, means top of the 9872 we're getting a maximum of 5,758. My tax credit is 15%. But if this child that we're getting the supplement for, and what happens is sometimes what happens is that supplement amount is reduced if you put the child to a child care care expense, child care if you put them in where somebody looks after your child, daycare, something like a daycare. So what happens is your supplement income, the supplement credit is reduced by the amount you paid to are deducted the amount that you paid for child care expenses or for any attendant care expenses. Also if there's any medical expense in calculating the medical expense credit. So if the child is you are applying for supplement, these are need to be taken out when you're calculating your supplement, and that supplement is 15% of this amount. So you're going to take it out of this amount. That's what you're going to do. So this amount gets reduced by what you pay to the child care expenses or any attendant care expenses. Now we also, when in order to have a disability tax credit, we are required to submit 2201 for that child. Who is going to complete this? A medical doctor, a nurse, or somebody that is qualified person is required to complete that. Now we are allowed other credits and deduction. So this is individual or sporting person can claim either not both. So you could have a disability credit or full-time attendant care costs as a medical expense, a medical expense tax credit. So you're not allowed to do both. Either you're allowed a deduction for the full-time attendant care costs as a medical expense. So what you could do is you can put this attendant care as a medical expense, or you can get a disability care. Either you allowed a deduction or a credit, not both. If you go to school, of course, you are a student, you're going to school, you're taking this course, you are going to get tax credit. Your tax credits are 15% of the tuition that you paid in the calendar year. It's your job to download it from the college site, and then how much tuition you paid to them. So tuition paid to the post secondary courses, like a college, the other will be for any fees that you paid for occupational skills, or fees you paid to the US, or for individual who lives near the US and commute to US college, and whatever tuition they paid to that college. Your tuition fees has to be more than $100. So there's no upper limit, but then there's a lower limit. Lower limit is $100 for the tuition fees. No course is $100. So most courses are over $1,000. Now, if for some reason you're working and the employee reimburse you for this tuition, so you go to school and you're taking courses, you are also working. If your company reimburse you, you're not allowed to put it on your income taxes because you're not paying it. Your company is reimbursing you. Now we all know that when you go to school, the cost of going to school is expensive. If it's expensive, we what we do is we get a student loan from the government. When we get a student loan, we have to pay them, and they are going to charge you interest after you graduate. And even though after they give you 6 months grace period, after the 6 months government wants their loan back. When they won't want their loan back, they're going to be charging you interest if you don't pay them. How much interest they charge you? 15% interest paid in the year or any 5 preceding year. And if you these are non-transferable, you cannot transfer this credit to anybody else. However, your tuition fees is transferred. Your tuition fees credit is transferred, and the maximum that you're allowed to transfer is to, if you are a student, you can transfer to your mother, to your father. You can transfer it. So this is what it is. The maximum that you're allowed to transfer in a 1 year is $5,000, but and then the credit we're gonna get is 15% of that. The EI insurance, like EI is an insurance, we call it an employment insurance, and what we do is we get a tax credit for, if you're working, there's three mandatory deduction. Those are CPP, EI, and income tax. When we think of it, EI. So when you have an EI, what we do is we pay to the service Ontario. The amount changes every year. So it is 1.66% of any income that you earn up to 63,200. And that, what does that do? That comes out to be the 1,049, and you get 15% of that. Now we know that this EI is deducted from your pay. If you're working for a company, you multiply this by 1.4, that will be the employer's deduction, and the employer will reduce their taxable income, because that's what they're going to do. If you have more than one employer, you work for one company A, company B, and company C, every company is going to deduct the EI from your pay, but at the end you are going to have an overpayment of an EI and a CPP. If that happens, you're going to get a refund from the government for the overpayment. So they don't keep that money. Your company A is going to submit your T4, company B, C, once they submit it, what we're going to have is we are going to get a refund for the overpayments. That's what you're gonna get. Now, some of the credits are transferred to your spouse or a common law. What are those two? Those age, pension, disability, and current year's tuition, maximum of 750. We said you're allowed to transfer 5,000. 15% of that will be 750. Now, if you contribute to a political contribution, so for example, you could be supporting liberals or NDP or PC, provincial conservatives. So what you needed to do is you're allowed credits. So we call it political contribution credits. So it has to be to a registered party, registered association, and to any independent candidate. Your This limit is increased every year. So the limit for 2024 that you can contribute is 1725. So that's what it is. So the if that's the limit, so that's the limit that you have is 1725. So what happens is this is the contribution. So this, if I were to think about it, this is your credit calculation. So um, when we think of it, the first 400, you get the credit is 75%. The next 350, you get a credit of 50%. The next 525, your credit is one third. So that's what have the maximum credit that you could get is your $650. Going further, we have a dividend tax credit when you invest into another company. When you invest into common shares, in return we get a dividend, and we're allowed a dividend tax credit. That will be covered in chapter 7. We have a foreign tax credit if you're working for a foreign companies, for example US, and you get a foreign tax credit. That will be covered in chapter 7 and 11. If you invest money, you get an investment tax credit. That will be covered in your volume 2. My next one will be, we have something called refundable credits. So refundable credits are paid slash refunded to the taxpayer to an extent not applied against the gross federal tax payable. So these are just the credit. It does not apply to federal tax payable. They are not carry forward. They are not to be used in the current year. If you don't use them in the current year, these credits are lost. Means you cannot carry forward. That's what it means. Now you get a GST check. Of course, if you are making less than the 44,320, your GST amount GST is given to low income families, so it's not applied to everybody. If you don't get a GST slash HST check at the end, that means you made a lot of money. So I don't know what is a lot of money. So when you think of it, you have these are the amount for the credits. These are the amounts that you have. So you're allowed for your spouse, your dependent, and all those. These are the total credits that we if you have a you have your individual one is 340. You have a spouse, that will be 340. Any dependent that is eligible, that will be 340. And for each qualified dependent, you're going to be getting 179. If you have 5 kids, you're going to multiply this by 5. If you have 1 kid, you will multiply by that much. Now, Canada Workers Benefit. So what happens to that? These are the Canada Workers Benefit given to minimum wages. People who works with minimum wages. Individual might be better off. Sometimes it plays a role that if you're getting a benefit from the government, why do I work? But then the purpose of is that if you will a minimum. So if you're working as a minimum wage, then sometimes you cannot make so much money. So the individual will be better off not working. But if you don't want to work, it will be there will be a reduction in your social assistance payment. um, the other reason will be why you get a benefit: your loss of subsidizing houses, loss of other benefits. So that's why uh, these are the reasons that you get the Canada workers benefit. So the Canada workers benefits only given to the individuals over the age of 19. And if you're working, you have an employment income. If you have a business, you have a business income. If you go to school, you might get a scholarship. If you're applying for a master's, you're doing a master's, you get a research grant. So your working income has to be more than 300,000 to be eligible for Canada workers benefit. This is new, well, not new so far. It came around about last year. It is available to only these provinces. We call it Canada Carbon Rebate Credit or a payment. So you get a check in the mail for carbon credit payments, and this is what that is. So depending on where you are, if you're living in Ontario, your quarterly payment is 120 for a single adult. For any second adult in couple or a first child single parent, you get that much money. So it's for if you have a child, if the child is under the 19, you got $30.50. If you have a you have an extra second adult in a sorry second adult. I don't know where this come from. If you have a second adult, sorry, I try to delete these. For some reason, these emojis are not deleting. Oh, there we go. I didn't mean to do that. It just clicked. So your quarterly payment will equal to 120 for a single adult. So if you're a single adult, you get 120. Second adult in the couple, if you don't have a second adult, you have a child, then you're going to get another $61. And if you have any child that is under the 19, you're going to get $30.50. So you get this and you get this depending on what applies to. Now 10% is additional supplement for individuals that reside outside the consensus metropolitan area. So the one is, if you think about it, if at some provinces gives you the CMA census metropolitan area, that's what it's called, you get an extra 10%. So what happens is that the credits, what happens proposing in what happens is there's a new credit came in, that is if this is a what happens in this case is that it's like a rebate. So in 20 in on July 15 2024 propose a new carbon rate for small and medium business. That's what is CCPC, with less than 500 employees that filed their 2023 income tax return by July 15. So that's what we're doing, is we're going to get a new carbon rebate. So now we all filed our taxes, so you will be getting those payments. This rebate is given to you retrospectively from 1920 to period 24-25. Now, of course, multi-generational home renovation tax credit. Now, if your parents has a small house, and what they wanted to do is they can renovate the house so that somebody else can live, or your other sibling can live there, if they got married. So this is what happens if you are if you're doing if your parents are doing a renovation, they are allowed a credit, and the expenses are 50,000 qualify expenditure. 15% of that, you are getting a 7,500. Going further to my social benefit, OAS is Ontario age supplements. That's what it is. Ontario old age supplements. That's what it is. Now there is a clawback, means the government takes it away. If you the clawback is called a clawback. What is the mean of clawback? Or is a repayment applicable if EI recipients net income exceed the 7,900. EI is when you get a laid off. Service Ontario gives you a check for EI while you were off of work. So when that happens, this is EI benefit, EI clawback payments. If your income exceeds 79,000, what happens is your clawback will be, they'll say whatever the EI benefits you receive, whatever the number you receive, excess of net income over the 79,000, you are taking lesser of the both, and then 30% of that will be your clawback. And when it's a clawback or repayment is deducted under the net. When we determine your net income, any repayments are deducted from your, when you're calculating your net income. So again, there's also a clawback for interior age old age benefits. So there's also a clawback similar to what we did, and it is exactly you get the old age benefits from who? From the government. So you're going, there's a clawback. If more money they give it to you, or more money you make, there's a clawback that you need to make a repayment. So that's where the clawback comes from. When you if you make in excess of 90,997. So this was something with the clawbacks, and this is, of course, when the you have to make a repayment if your threshold becomes more than what the amount is prescribed to us. If that's the case, then we have to repay the government. If you don't repay them, if you repay them, government will withhold your OAS payments, expected to be a clawback. So they are already going to figure out from your last year's income, and they will withhold before sending you the check. Thank you so much for listening to me. This was part B of chapter 4. We did some examples, and I will try to find more examples so that all the credits that we did. So we want to know which credit applies to according to the question. So thank you so much for listening to me. Don't forget to subscribe, and don't forget to like my videos if you're watching my videos. Take care and bye for now.